Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a forward contract to manage foreign currency risk from a purchase. So we're going to have a purchase taking place. We're going to have a forward contract that is there in order to manage the foreign currency risk related to it. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side, including our journal entries and our worksheets, our trial balance worksheets where we have year 1 and year 2 worksheets. Let's take a look at our data. We have on 12/1/X1, the U.S. company, that's us, entered into a 120-day forward contract to purchase Australian dollars, 100,000 of them. We have the relevant spot rate and forward rates. We'll come back to them in a second. The forward contract was to manage the foreign currency risks from the purchase of furniture 12/1/X1, and that was for 100,000 Australian dollars. We promised to pay that amount in the future on 3/31/X2, the foreign contract not designated as a hedge. Okay, let's recap that. We're purchasing from an Australian company in Australian dollars furniture on 12/31/X1, the current year or the first year, year 1. But we're purchasing them on account, promising to pay 100,000 Australian dollars in the future 4 months later on March 31st, 2000X2 in then year 2. Obviously, because we have that difference in time, there could be a difference in the exchange rate from the purchase point to the point in time that we make the payment. Therefore, the forward contract was to manage the foreign currency risks from the purchase of the furniture. The forward contract then taking place, we're going to do that at the same time. We're going to enter into a forward contract at the same time that we make this purchase or promise to pay for the purchase of furniture in order to manage that risk. That's going to be on 12/1/X1 then. We entered into a 120-day, which is 4 months, because that's the same time period as the point in time that we have the accounts payable on the books for the purchase of the furniture. Contract to purchase Australian dollars for 100,000. The relevant spot rate then is what we'll typically be using with regards to the value of the furniture and the accounts payable as we have seen in the past. Then the forward rate then it's kind of like the predicted rate, we can think about it as of each point in time as we go through time, the predicted rate up until that future point, which the future point is the point that we actually make the payment, which is going to be the 3/31/X2. So we're always predicting to that future point in time what the rate will be. Predicted rate kind of you're thinking of as of, the current date that we're at, predicting to that future one point in time. Okay, let's record this out. We're going to say first, let's think about the thing we've seen in the past. We purchased inventory on 12/1/X1. It's not going to be inventory. I'll put depreciable asset. We purchased furniture. So we're going to say the furniture is going to go on the books. We purchased an asset. And then we have a payable because we're going to pay it in the future, but we're going to be paying it with Australian dollars. We're going to put it on our books in US equivalent dollars, noting with the AUD that we're going to be paying them in Australian dollars, but on our books, we're valuing them in current dollars. We're going to be using the spot rate in order to do that. So we're going to be paying 100,000 Australian dollars times the current spot rate, the current exchange rate at the point in time, at this date, at 12/1. So we've got the 100,000 times the 0.6 at the spot rate. There's our debit, there's our credit, now 60,000. So the depreciable asset then going on the books, the furniture going on the books for the 100,000, basically valuing it at US dollar equivalents at the point in time purchase was done, even though we haven't yet paid for it, but we have promised to pay for it in Australian dollars. The payable side then is going to be a payable of 60,000. We're recording that in US dollars, but again, noting that we're going to be paying it in Australian dollars and having to do with any kind of differences that happen. Now, in order to deal with that kind of difference, in order to manage the foreign currency risk, we entered into our forward contract to purchase Australian dollars. So that is in essence going to be recording on our books this contract, basically a receivable and a payable at this point in time. So we're going to say that we have a receivable, foreign currency receivable from the exchange broker, and we have a foreign currency payable to the exchange broker. And note we have in US dollars versus the basically Australian dollars. So we're recording the receivable and the payable due to our forward contract. And this one is the one we're going to be using the forward rates for. So now we're going to be using the forward rate at this point in time. So this is going to be equal to the 100,000 times the 0.609. And this is going to be, let's say, just negative of that number. So now we've got on the books the foreign currency receivable of the 60,900 and the dollar payable to the exchange broker in dollars now of the 60,900. Let's record this out. We're going to say then, all right, we've got the receivable, the 60,900, and notice this is indicating that it's going to be in foreign currency. That means we're gonna adjust this one for the time value of money as it goes. This one's basically in dollars down here, right? We're not going to be adjusting this one, okay? So then we're going to say this one is going to be the credit. So there we have that. Now we're going to say what happens at year end. At year end, we're going to have the balance sheet date. We're going to have to adjust both of these as of the balance sheet date, recognizing any gain or loss on currency gain or loss. So this happens on 12/31/X1, balance sheet date. Let's do the first item, which is the same that we have seen in the past, revaluing, in essence, that accounts payable. So we're going to say, all right, they got this payable on the books that we're going to be paying in Australian dollars of the 60,000, but now it's 100,000 times we have the 0.61 times 0.61 is going to be the 61,000. So we have that difference, that $1,000 difference, which basically the payable valued in US dollars is now higher, which means we basically have a loss as a result of this. Why? Because if you think about it, the spot rate, 1 Australian dollar is $0.6 before, and now 1 Australian dollars is worth 0.61 US dollars. So the Australian dollar got stronger compared to the US dollar. The US dollar got weaker compared to the Australian dollar, and we're going to be paying in Australian dollars, which now got stronger. So we actually we kind of owe more then because of that. So now we're going to say then that we have we have a loss, which is going to be a debit, and the payable is going to go up with a credit in terms of US dollars. And I'll do that same calculation this way. This equals, we're going to say brackets, this 0.61 on the spot rate. I'm just going to take the higher one minus the lower one that we're dealing with, because the debit's always going to be positive, times the 100,000. So there's that same calculation of that 100,000. And so there we have it. Let's record this out. We got the debit going to the loss. So we have this loss of the 100,000. The other side going to the payable. Double clicking on the payable, going to the end of it, plus picking up that 100,000. Now we're at the 61,000, and that of course is the current value that we owe in US dollar kind of equivalents. Now we're going to do the same kind of thing for our forward contract. Now we got to revalue the forward contract. Now in the forward contract, notice we're not revaluing this side because the dollar payable to the exchange broker is basically in dollars, right? We are revaluing the receivable side. So we're going to revalue the receivable side, and we're going to do the same thing, but now we're using the forward rate. The forward rate has now changed. So we're always got the same focal point, the end point, 3/31, the payable date. That's why we set up the forward contract at that date. But now we have the change in the prediction amount to that future point. So now we're going to say, all right, we're going to take that same 100,000 times now the 0.612, and that's going to be the 61.2 versus that 60,009. So minus the 60900, we have the $300, and that's going to be a gain. And so it's going to be a gain because, once again, we could see here that on the forward rate, it was 1 Australian dollar compared to 0.609. Now it's 1 Australian dollar compared to 0.612. Australian dollar then got stronger, US dollar got weaker, but this is a receivable. Therefore, we can think of ourselves as getting Australian dollars, which now got more valuable compared to the US dollar. So this is a gain to us over here. And that's why that's kind of like why we did it, because we did the forward contract with to manage the foreign currency risks. So these two, you would think these two would generally kind of offset, gain loss offsetting to some degree. So we're going to say, all right, now we've got the receivables going to be going up, and then the other side is going to be going to the gain. And we'll do that same calculation this way. I'm going to say brackets equals the brackets. I'll take the bigger of the forward rates minus the smaller of the forward rates. So the debit will be positive, brackets, and then we'll pick up the 100,000. There's our 300. There's our debit. There is our credit. Let's go ahead and record that out. So we're going to go up to the receivable up top. Receivable up top. I'm going to double click on it, go to the end of it, and plus, pick up that $300. Now it's currently at the 61,200 as we calculated. And then we've got the foreign currency transaction gain. It's going to be this item down here, the 300 gain. And you might say, how did we calculate that one more time? Let me just, 61,200 is the 100,000 times this item, the 0.612. So there's the 61,200 valuing that receivable at this point. So now we're going to say that in year 2, that's when this thing actually was paid. We're going to pay this thing. So we got to revalue it. We've got to revalue it again as of the time that we're going to make the payment. And then we got to make the payment for it. So let's revalue the payable first. Let's think about the payable, which is currently on the books at the 61,000. So let's do that. This is going to happen on 3/31x2. And now we're going to say, all right, so now like using the spot rate, we had the 100,000 times, and now it's the 331 times 0.602. So we got the 60,200, and it's currently on the books at the 61,000. So minus the 61,000, it's going to be an $800 difference, and it's going to be a gain this time. So we have basically a gain that's going to be resulting from it. Why? Because before, we're up here on 1231, it was 0.61. 1 Australian dollar was 0.61 US dollars. Now 1 Australian dollar is worth 0.602. So the Australian dollar got weaker versus the US dollar, or the US dollar got stronger versus the Australian dollar. And we're going to be paying in Australian dollars, which are now worth less compared to the US dollar. So that's good for us. So we got like a gain happen here. So we're going to say, all right, then we have the accounts payable is going to go down in terms of US dollars. So I'm going to record it in year 2 accounts payable. And then we have a gain that happened. So we have a gain, and let's calculate it this way. This equals, I'm going to put brackets. I'm going to take the bigger of the two numbers we're dealing with. So the debit will be positive minus the smaller of the two, and then times the 100,000. There's the 800 debit and credit. Let's record this out then. So we've got the accounts payable. So this is going to be equal to the $800. That's going to bring us to that 60,200 we calculated. And then we have the gain down below. The gain down below will be equal to the $800 credit. So now let's think about what happens with the receivable. What happens with the receivable up top? So we're going to say, we're going to adjust in the forward contract. We have the receivables on the books at this 61,200. And now if we think about our information, you're going to say, hey, there's no amount here for 331x2. Why, where did that go? Why? Because now we're at this point. There's no forward future rate because we're at that point in time. So we don't need a future rate. Now we can use the spot rate because it is what it is. There's no prediction involved here. So now we're going to say that we have, once again, the 100,000 times the 0.602. That's going to be the 60,200 compared to minus what's on the books at the 61,200. So we have a change or difference of the $1,000 difference. And that to us is going to be a loss to us. Why? Because before we were using this 0.612, so 1 Australian dollars, 0.612 US dollars, and now 1 Australian dollar is 0.602, which means that we have the Australian dollar went down or got weaker with regards to US dollar. US dollar got stronger. And in this case, we are going to be paid in Australian dollars. This is a receivable. So, and we're going to get paid in something that's worth less. So that means that we had a loss on here. And again, the gains and the losses typically with regards to this should kind of cancel each other out to some extent. So we had a gain here. It would make sense we got a loss here. So we're going to say, all right, now we got a loss on the foreign currency transaction. And the other side is going to be going to the receivable. And I'm going to be then saying that I'll calculate it this way. This equals, I'm going to be picking the bigger of the two numbers, the 0.612 minus the smaller of the two numbers, brackets, and then multiply that times the 100,000. There'll be the debit and the credit. So here is the loss. We're going to record that down here. This is going to be equal to that 100,000. And then we've got the receivable up top. The receivable up top will be equal to that 100,000, bringing our receivable to that 60,200. So now we have this payable down here. The payable's now due the 60,900 in dollars. It's a percent. It should be a dollar here. It should be a dollar sign. And so we're going to pay that amount. So we're going to say, all right, so this happens on 3/31 because this is the amount is due for the forward contract. So we're going to say, all right, I'm going to pay that off in dollars. That's no problem from a foreign currency factor. So that's going to be the 60,900. That hasn't changed, notice, since the first transaction we did here. That's all that's it. All right, that's all that's there. Now we owe it. So we're going to pay it. With cash. So we're going to say then this one is going to be debited by the 60,900, and we're going to be paying that one off with cash. Go ahead and pay that with cash. So the cash is going down, paying that item off. So next we're going to be receiving this foreign currency, this 60,200. We're going to be receiving basically the 100,000 Australian dollars at this point, right? We're going to get that money. But now we're going to value that on our books at basically the rate at this point in time, which we now have at the 60,200 as our receivable has been adjusted to that point. So we've got so that means that we're going to call it then the foreign currency in units, and then we're going to get paid from this amount here. So this is going to be the 60,200, which once again you could calculate if you want. It's going to be, of course, that 100,000 times the current rate, which is the spot rate, is that 60,200. So there's going to be the debit and the credit. So we got the foreign currency. We're going to recognize it that we have foreign currency, right? But we're going to record it basically in US dollar valuation as of this point in time. And then this amount's going to go down. So I'm going to say plus, and we'll pick up the credit for that amount. And then we've got the payable that we're going to be paying off, basically the payable, and we can pay it now with that foreign currency that we have, right? So we're going to say, all right, so now we've got the payable. The payable is going to go off the books. We're going to record the payable, and we're going to pay it not out of cash, but the foreign currency. So it's kind of like cash, but of course it's in foreign currency. And once again, we have it on the books at the valuation of the 60,200, representing now the 100,000 Australian dollars that we have. So we're going to say, all right, so, and then you can do the calculation again. It's basically going to be that 100,000 times the 0.602. So there we have that. And so then the accounts payable, I'm going to double click on it, say plus. We're going to pick up that accounts payable. And then we've got the foreign currency in units is up here. Double click on it. Let's go to the end of it. Plus, we're going to pick up that 60,200. And that brings us back down. So we got the cash. We got the cash on the books. We basically reduced back down the foreign currency and paid the foreign currency out. And then we have the foreign currency receivable back down to zero. We got the depreciable asset, which was the furniture, on the books for basically the original price with the original exchange rate that we put it on the books for at the point in time of the purchase. We have now closed out the accounts payable in Australian dollars. The dollars payable to the exchange broker for the forward contract is now been closed out, and we've been recording our gains and losses for the current year and the prior year.